The concept of investing your money can seem quite vague and daunting to a beginner. Our aim today is to give you a simple, straightforward guide to investing, showing you why you'd even want to invest in the first place, what your investment options are, and how you can actually make your first investment step by step in a tax-efficient way. And don't worry, this will be as easy as it gets.
Why don't you explain this to me like I'm 5?
If you still have any questions after watching, we'll answer everything down in the comments below. Also, nothing I say in this video is a recommendation. Examples are used for educational purposes. I'm not a financial advisor, and all investments do have risk. Before you even open a broker account and look at where to invest your money, you have a pretty big question to answer. Why do you want to invest? Is it because your friend at the pub told you to? Or did a self-proclaimed finance god on the internet say that you could be rich in a year? The reality is, the aim of investing your money shouldn't be to get rich quickly. That's not what this is about. In fact, most people aim to use investing to get rich really slowly, using smaller returns that add up over time and help you to increase your chances of a secure retirement. Over the last 30 years, we've seen an average yearly inflation rate of roughly 2.5%. And this is only the official inflation figure. Some people do suggest that it's actually higher than this in reality. And this inflation eats into the value of your cash over time. If it's just sat in a bank account and not generating interest, you're actually guaranteeing that you lose value on your money. If you lose 2.5% of your purchasing power every year, it doesn't take that long before you can only afford half of what you could previously. Some people think that investing is risky, and yeah, it does have risk. But if you want a guaranteed way to lose value, then just leave your cash sat in a normal bank account. Even high interest savings accounts don't always beat inflation. Investing your money in the stock market instead of watching it slowly burn is a potential way to beat the bank's offered interest rates, while also beating inflation rates, hopefully generating you a literal return on your money. As in, you get out more than you put in, but also in real terms. The price of things goes up over time, so we don't want to just have more money in the future. We want to make sure we can actually afford more stuff. Some popular investment options have had a yearly return of around 10% over the last 50 years, and 10% might not sound like much to some people, but if you understand how compounding works, you'll see how that can add up significantly once you start earning returns on your returns. But the thing with investment returns is they're not guaranteed, and results are not exactly linear, they're volatile. Sometimes investments can decrease by 20% in one year and then increase by over 30% in the next. But it's when you look at the long-term average that you see the possible benefit. So when asking yourself whether or not you want to invest your money, you need to have the right mindset when approaching it. This isn't some get-rich-quick scheme that will make you millions overnight. Investing is a long-term game where you put money away hoping to ride out short-term falls in the market to be able to cash out for a larger amount in the future. Using historical figures, if you invested for just 1 month, you'd have a 40% chance of losing money. For 12 months, that figure decreases to 30%, and at 10 years, that figure decreases all the way down to 13%, and finally, over a 20-year period, you'd have made a return every time, even when accounting for inflation. There might be times where your investments will suffer, and you think to yourself, I'd better withdraw and cut my losses. But in the past at least, it's been far better to ride things out for the long term and keep putting money away even when times are tough. There also might be times where you think, I'll wait for a dip in the market before I invest, or I think the markets are going to go down, so I'm going to sell and rebuy later. Unfortunately, this is a mindset that is highly likely to cost you, and it's probably driven by online content creators that claim trading is easy. It's not. The smartest traders in the world struggle to beat the 10% returns that we've already mentioned, and content creator traders are almost certainly not generating the returns they claim. If they were, they'd be being paid 7 or even 8-figure salaries by the biggest financial institutions in the world, not selling access to a Discord community and teaching you how to steal their income. Generally speaking, average investors like you and me are not smart enough to know which stocks to pick or when to buy them. And if you have made it this far in the video, then you're smarter than TikTok traders. Trust me. Legendary investors like Warren Buffett believe that time in the market is better than timing the market. Not trying to time investments perfectly, but instead just being invested for a period of years, not days or weeks. Trading is essentially gambling. So let's look at the types of returns that you might be able to generate from long-term investing. If you invest £500 a month and achieve a 10% annual return, you would make nearly £1 million in profit after 30 years. And you don't have to invest that much. It's really about investing what you can afford to invest, no matter how small that is, as long as you've decided you definitely want to do it and that you understand the risks. Even if you started with £100 a month and increased your deposits by just 5% each year, you'd still end up with over £359,000 after 30 years if the average long-term results continued in your favour. Like I said earlier, this is about trying to set yourself up for a comfortable retirement. And with the way the economy is these days, being able to retire in the first place might put you in the minority. Now you've got that investing cap on and you're not expecting to become a millionaire overnight, let's have a look at what you could potentially invest in. We personally invest in the stock market, but we don't pick individual stocks like Apple or Tesla or Amazon. But we previously mentioned a 10% annual return. So where did that come from? Well, this came from something called an index fund, and it's an index fund that focused on the S&P 500. This might all sound scary and confusing, but I'll break it down for you. An index is just a fancy term for a list, or in this case, it would be a list of companies grouped together by shared characteristics like their geographical location, company size, or market sector. The index that the S&P 500 tracks is the 500 biggest businesses in the United States. A fund is simply a pool of money that invests into something, which here would be the index or list of businesses that it's tracking. So an index fund is just a pot of money that's being invested into a specific list of businesses. An S&P 500 fund would be an index fund that invests into the S&P 500, or the 500 biggest businesses in America. Hopefully that all makes sense. Indexes can vary massively. For example, there's also a FTSE All-World Index, and we're actually going to use this for our example today. It's what's known as a global index. It covers large parts of the world and over 3,000 different businesses, making things really diversified. While returns have been slightly lower than the S&P 500 historically, it's slightly lower risk too because of having more coverage. Remember when I said that we're not smart enough to pick stocks or trade? Well, we don't really believe that we can even pick which markets are going to succeed long term either. The UK is an obvious example for markets that many people would have backed heavily not too long ago, but now appears to be in a period of uncertainty. The American market looks strong right now, and lots of people like the S&P 500, including Warren Buffett, but we're going to go worldwide. Importantly, this still gives us lots of coverage of the American market, and this is because the index is weighted. It invests more into certain companies than others, based on their size. And at the time of recording, 62.7% of the index is focused on the US. Not all index funds are market weighted like this, but the most popular ones usually are, and we're focusing on those today to keep things simple. We're also looking at passive index funds, meaning they're passively managed, so they automatically try to replicate the performance of the index. There's no investment manager actively trading your positions, which usually comes with a lot higher fees, and often performs worse than the passive option. If businesses in other countries grow massively, then the index will automatically reflect that, and therefore so will our investments. And if one company starts to perform badly, then your investment will be propped up by the other stocks that you own. And if one company starts to do extremely well, you'll automatically have exposure to it. So there's no individual stock picking here. If a random company rises out of nowhere like Nvidia did in recent times, you'd have exposure to it. If a big company failed, you'd automatically sell it. As the founder of Vanguard once said, why look for the needle when you can just buy the whole haystack? Index funds allow you to passively invest your money into them as often as you'd like without having to worry about managing the investments yourself. You can either invest into an accumulation fund, which will automatically reinvest your returns, or what's called a distributing fund, which will pay your dividends out when you receive them, allowing you to either reinvest them yourself or withdraw the money. The 10% figure that we mentioned previously assumes that dividends were reinvested. Now we've answered the questions of why you should consider investing in the first place, and what you could potentially invest into without needing to analyse stocks for hours each day, it's time to look at how you actually invest if you wanted to do so. For the purpose of this tutorial, I'll be showing you how to invest into an index fund through the Trading 212 app. And while this isn't a recommendation of which broker you should use, you can get a free share worth up to £100 if you create your account using the link in the description. And you can deposit as little as £1 if you'd like to test them out whilst following on with the rest of this tutorial. I'll also put another link in the description that can help you compare the different brokers and their fees if you wanted to shop around, but at the time of recording, Trading 212 is the cheapest option on the market. So, first things first, if you're a UK investor, it's important that you take advantage of the tax-efficient accounts on offer to us. One of the options for you is to use a stocks and shares ISA, And I cannot stress enough that you should be investing inside one of these accounts, as you won't be required to pay any capital gains tax or dividends tax on your returns. You just have to make sure that you stay within the annual ISA limits, which includes cash ISA deposits. To open one of these accounts with Trading 212, simply select the Stocks ISA option when setting up your account, and that's honestly all there is to it. There's no charge for opening it or even using it. If you're not in the UK, then use the Invest account, or maybe a different tax efficient account if they're offered in your country. Once you've opened the account and filled in all of the mandatory personal information, which every regulated broker will require you to do, you'll need to deposit some cash. To do this, click the menu option in the bottom right of the phone app or top right of the desktop app, and click the big blue Deposit Funds button at the bottom. This will prompt you to select a payment method, and you get to choose between 4 different options. There's Instant Bank Transfer, Card, or Apple/Google Pay. And here you'll see that the top 2 options are free, and the bottom 2 will charge you a 0.7% fee on deposits after you deposit £2,000. Luckily, there's no limit to how much you can deposit via the Instant Bank Transfer option, and this is easy to set up if you just follow all the prompts that are given to you, with the deposits being, as suggested, instant as well, so there's no reason not to use this option. After you've linked that preferred payment option, you can now click on it to pull up a slider allowing you to decide how much you'd like to deposit, but if this is too fiddly for you, then you can just tap this keypad here, where you can input your desired amount. So that's it. You've got some money in your account, and you should receive your free share if you signed up via our link too. And if it didn't work, just enter the promo code FIN and you should get it instantly. Now it's time to invest into an index fund. Although, technically speaking, these are actually ETFs or exchange traded funds, as Trading 212 don't actually offer traditional index funds. Many modern brokers only offer ETFs, and they're very close to being the same thing, but ETFs are a lot more simple to buy and sell. To find their range of ETFs, simply click on the little search icon here and you can scroll down to view the most popular ETF section. Or alternatively, if you have a specific fund that you'd like to invest into, you can just type it into the search bar at the top to bring it up. For this example, we'll use the FTSE All World Index that we mentioned earlier, and the fund provider is Vanguard. So this is the Vanguard FTSE All World Index ETF, and its ticker is VWRP. Again, this is not a recommendation of what you should invest into, we're just using this to explain the process. Once you've found the fund that you want to buy, you can see all of the details you'd ever need by scrolling down, and then you can buy the fund by simply clicking the big buy button at the top. This will bring up a similar slider to the deposit feature, again with the option of a keyboard for specific amounts. Here you also have the option of how you view the transaction, so whether you want to see the amount that you're buying in terms of its value, or the amount of shares that you're actually buying. So just decide how much you'd like to invest, and then hit review order when you're sure. You'll see a quick overview of the investment before you hit confirm, so if you're content with everything, you can complete the purchase. And that is how to invest into your very first index fund. If you want to set up a recurring investment, for example once per month, I'll link a tutorial in the description and at the end of the video that you can follow. But I must stress, it's important that you do your own research before you invest, so you know exactly where your money is going. Hopefully this video has at least given you some food for thought when it comes to investing your money. You need to be free to draw your own conclusions about whether this is a suitable idea for you based on your own situation, so don't just take what we've said as gospel and speak with a professional if you are unsure. As we discussed earlier in the video, investing should be a long-term game, and you should always approach it like that if you want to give your money the best chance of compounding in value. Of course, no investment is guaranteed to return you money, but as long as you're putting your faith in the market and not selling up as soon as times get tough, you'll be in the best position to benefit as much as possible. Remember that you have a relatively high chance of losing money over short-term timeframes, and you shouldn't invest money that you can't afford to lose.